You're probably familiar that the Fed already cut interest rates. It did so last week by 50 basis points. It was a pretty aggressive rate cut. And in anticipation of that, and since then, some stocks have performed very, very well. And one of them is real estate company Redfin. Ticker symbol RDFN. It is up 115% in the second half of 2024 alone. So that's since July 1st. It has more than doubled. So I think it could have a lot more room to the upside. We're going to talk about why it is up so much. Before we dive into it, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It's the best way to support this work I'm doing, and you can get a lot more stock ideas in the process. So again, fool.com/Frankel. So I want to share my screen real quick. So Redfin, like I said, it's already more than doubled just since July. So here, let me share this. A lot to talk about. So first, the bad news. Redfin, its revenue really shot up during the pandemic and the housing boom when the real estate market was kind of going crazy, and it has since fallen off considerably. If you just see the green bar, the real estate services, that's the core brokerage business. And you can see that really has fallen off from $903 million in revenue in 2021, steadily declining. It's lost quite a bit of that by 2023. And this year, honestly, has not been that much better. But what the company has done a great job of is really to focus on sustainability. They got rid of the more uncertain and honestly money-losing parts of the business, like Redfin Now, which was their iBuying business, focused on more of the profitable parts of the business, like the rental business that they acquired and the mortgage business they acquired, both of which are profitable right now, despite the fact that the company is still losing money. And it really kind of pared down its headcount. It made the difficult decision to go through a few rounds of layoffs and really just kind of focus on sustaining the business no matter what the market is doing. Obviously, they want a great market so they can make a lot of money, but they want to also be able to survive bad real estate markets. And the business really, up till 2 years ago, was not positioned to do that. Excuse me. So if you see these charts on your screen, the two charts on the bottom are the big ones to pay attention to. The trailing 12-month adjusted EBITDA. You can see Redfin was losing a lot of money. This is even after they wound down the Redfin Now business. Over a trailing 12-month basis, on an adjusted basis, their EBITDA loss was well over $100 million. That has narrowed considerably to $33 million from $123 a year ago in the second quarter last year. So that's a big, big difference. Net loss is still about the same, but that should take care of itself as the company continues to really focus on its most profitable parts. Gross margin is up by 70 basis points year over year. Really impressive job by management. There's a few reasons why. So that's really why the company has done as well as it has, not just in anticipation of interest rates falling. We've already seen mortgage rates fall from a peak of about 7.9% towards the end of 2023, so just about a year ago, actually. And now they are just over 6%, so almost 2 percentage points down from the peak already. But that could just be the beginning. That's really in anticipation of interest rates falling. If the Fed continues to lower interest rates, a lot of experts expect mortgage rates to gravitate into the 5% range as early as the beginning of 2025 and really kind of keep falling from there. Now, no expert that I've seen believes that the 3 and 4% mortgage rates we saw a couple years ago are coming back anytime soon, if ever. But mortgage rates in the low 5% range would probably do a whole lot towards reinvigorating the real estate market. It would create a lot more existing homes for sale. That has been a big problem lately. I'll show you this chart. Let me blow this up so everyone can see my little chart right there. This is existing home inventory in the United States. You can see it's thanks to a combination of seasonality and somewhat lower mortgage rates. It's picked up a little bit. The summer is the biggest, the busiest season for real estate sales. But if this is the 10-year trend, and you can see it just really trending downwards over the past 10 years, it's not just the higher interest rates that we've seen. These are existing homes on the market right now, and 1.35 million might sound like a lot, but 10 years ago it was over 2 million. So there was a lot more inventory on the market back then. So in anticipation of that, that's one of the reasons that it's gone up quite a bit. And remember, Redfin owns a mortgage lender now. They own Bay Equity Home Loans. That's already a profitable part of the business. Mortgage volume, especially refinancing, is a fraction of what it was in 2021 when mortgage rates were low. And all the people who bought houses over the past couple of years got interest rates of 6%, 7%, almost 8% in a lot of cases. We could see a big wave of refinancing if mortgage rates fall to the 5% range. So those are just a couple of the reasons. A few more reasons, excuse me, why we could see Redfin continue to rise. The National Association of Realtors settlement just went into effect. I've talked about this before. This essentially makes it takes buyer's agent commissions out of the MLS. So the standard 3% commission that was charged to sellers for buyer's agents without them even really having much say in that for years and years, that could be a thing of the past now. Now buyers have to sign agreements with their agents saying exactly how they're getting paid. Sellers can have buyers pay their agents out of their own pocket. It's not terribly likely. But the big point is that consumers or buyers and sellers of real estate are becoming a lot more fee conscious than they were just a few years ago. So this could be a great fit for Redfin's discount model. Redfin has always been the discounter. They charge half the standard commission when you're selling a home, 1.5% instead of 3%. Buyers will presumably get a nice discount. But this model didn't really take off to the extent that a lot of people thought it would, just because people who are buying and selling houses have not been very fee conscious for a long time. With that changing, that's a natural fit for Redfin's business. I think that's a long-term tailwind. And just speaking of other long-term tailwinds, there is still a big housing shortage in the U.S. Depending on what source you're looking at, we have demand for about 4 million more homes than there are in the United States. Now, a lot of that's multifamily housing and affordable housing and things like that. But single-family homes make up about 1 million of that 4 million housing shortage. So there's a lot of pent-up demand for houses. Affordability has been low for the past 2 years with mortgage rates high. Right now, the mortgage rates just fell to their lowest level since September of 2022, so 2 years ago. And so there's a lot of would-be home buyers who want to buy a house for their family, who are currently renting an apartment, things like that, who are staying on the sidelines, who really could start to find that the market's becoming a little more affordable. So we could be entering kind of a very nice period for real estate. It's not without risk. This is cyclical. If we get a recession or something, for example, that could really derail this thesis. But right now, the stocks has more than doubled since the middle of the year, and it's not for no reason. There's a lot to like about Redfin right now. Still a very, very small company in terms of stock market standards, about a $2 billion market cap. And I think it could go a lot higher from here. It's a stock that I have quite a bit of, and I'm holding on to. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.